Ladies and gentlemen, good day and welcome to the Orient Cement's Q3 FY22 results conference call hosted by ICICI Securities Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Krupal Maniar, ICICI Securities. Thank you and over to you.
Welcome to everyone. On behalf of ICICI Securities, we welcome you to the third quarter earnings call of Orient Cement Limited. On the call, we have with us Mr. Deepak Khetrapal, MD and CEO, and Mr. Soumitra Bhattacharya, CFO of the company. At this point in time, I will hand over the floor to Mr. Deepak Khetrapal for his opening remark, which will be followed by interactive Q&A session. Thank you and over to you, sir.
Morning, everyone, and welcome to our earnings call for Q3 FY22. It's always good to sort of meet so many people, and earlier we were not doing it, but I think now it's becoming a habit with me also as well as with all of you. So here we go. Well, coming to Q3, I guess all of you, even more than we had perhaps seen the results that have been coming out from Cement Biggie so far. And I think it's well known that it's been a rather soft quarter for the industry as a whole. And so to that extent, yes, we are aware that it not only was it a soft quarter, we also generally, but still let me touch upon the main reasons being I think the extended rains which continued till well into November, October and beyond that into November also. In many parts of the country, not just some parts, but our parts of the market were quite badly affected that also. And again, typically we do expect the labor shortages which happen till about Diwali until about Chhath Puja time. And soon after Chhath Puja, we start getting adequate labor coming back to construction sites. But this year, surprisingly, that didn't happen. It took much longer than it should have. And then there were sand issues in some markets. There were, construction banned due to pollution in northern India and things like that. So obviously, it's multiple factors coming and hitting. But even all said and done, the fact of the matter is, yes, and the industry has struggled during Q3. In our case also, you would have noticed when we are actually reporting the total volumes, which are at 12.18 lakhs as we reported, on year-on-year basis, it's nearly 10% down. And we obviously are not happy with the figure of 10% down, but I'll explain what happened. And even sequentially, we are down 5% on the surface, but knowing that in the previous quarter we had not very large, but still some quantum of clinker that was sold in the previous quarter, which obviously was somebody needed and we supplied. It's not our regular business. So if we didn't take clinker into account, the cement sales are down sequentially just 3% and not 5%. And in terms of the revenues, it's been pretty steady to slightly firm, but the volumes have been hit, and there's no getting away from that. So let me just tell you our perspective on the volumes being down and how we still feel that we've done the right thing. We have done the right thing not because the entire loss is caused by the market. Partly it's been our very conscious call, and some of you who may have read our earnings release that we send out every quarter. See, this quarter when we started, we knew that the fuel costs and fuel supplies also, there were anxieties because even the Indian domestic mines had to still recover from the rains, and the on day-to-day basis was rather uncertain. And we at our company somehow were very anxious about the escalating. We had the fuel, but we also, rather than taking the decision on sales based on what we call historical cost price as it gets booked into the P&L, we were taking our decisions on where to sell, where not to sell based on the replacement cost of the coal. Because we didn't want to go wrong, just sort of utilizing the coal stocks that we had, and then suddenly getting hit by such a large increase in coal cost. So that was a major driver while we and as a result of that, what we did was we kept our margin on our keen eyes on margin on almost every ton of coal that we were consuming, and that became our mantra. Rather than saying I want margin per ton, I was saying how does it pan out in terms of usage of coal, and that's what we maximize that. So this focus on realizations, when I say, and obviously margins, led us to obviously picking and choosing markets where we sell very carefully. Chasing volumes, which typically is I would say the habit of the cement industry, we've tried to sort of contain that habit in our company, not just this quarter, but even earlier we were doing it, but this quarter it became a lot sharper. And we sort of chose a sales mix which will protect our margins per ton of coal that we were consuming. And in that sense, we chose not to sell to some of the markets which are non-core for us. And the first thing that I want to reassure every one of you is that we haven't lost any market share or any volumes in the markets that we prefer to operate in. So whether it's our markets in Maharashtra, our markets in Telangana, our markets which are in the right parts of Karnataka, those markets we actually have fully supplied the maximum that we could, and we've gained market share in those markets. The markets, for example, the markets we gave up were every month, every quarter, we on a regular basis we supply some cement to our tertiary markets, like for example Kerala is one market where we do not have our own sales network. We don't appoint dealers. We just have some large traders to whom we supply the material and then they sell. It's under our brand, in our bags, everything is done. But by the time the cement reaches Kerala, the net of realization, the earnings are much lower. So in this quarter, we went very, very low in Kerala. Similarly, there are some markets where the difference between the trade and non-trade prices have become very large. And in certain markets, which were again far off from our plants, we chose not to sell to the B2B segments. B2B segments, as all of you would appreciate, is largely a price-driven market. There, your branding, your service, your quality of cement, as long as you meet the minimum required quality standard, beyond that, the B2B customer is not wanting to look at other things. So we chose not to supply to those markets, and in that sense, didn't join the other brands who were lowering the price to the B2B market to keep booking the volumes. The comfort that we have with not catering to those markets in one particular quarter or a few months is not anxious, because knowing that those markets are price sensitive, I'm talking about B2B market, anytime we can move into those volumes and pick up into those markets and pick up the volumes again. So it's not a threat to our ongoing share in the core markets and our strength, our brand strength in the markets that, like I said, that we choose to operate in. And we are quite sure that the moment we have the comfort with fuel costs, we would be able to go back and pick up the same B2B customers again all over without sort of any major concern. This strategy, by the way, is also supportive of what the strategy we adopted not now for the last 2-3 years of slowly, gradually improving our realizations, what we term as bridging of price gap between us and the A category brands, which I know historically we have a legacy. We've suffered lower pricing compared to the market leaders. And we have not been happy with that, and we've been briefing all of you from time to time that. So in that sense, picking up the priority towards price realization in our core markets, our brand strength is strong, our service strength, network is strong. That also got further strengthened by our, let's say, sticking to that even when we were sort of losing perhaps a little more volume that we would have liked to. But given the fuel insecurity, I think we were better off changing the strategy. As a result of that, you see, while the volumes are down, but the overall fall in EBITDA in terms of rupees crores or even in terms of EBITDA per ton, I think we managed to sort of stem the tide which was there in the market, which sort of hit the profitability of the industry as a whole. And most of the results which have come out confirm that the hypothesis on which we worked perhaps has been the right one. And we're actually quite encouraged that we followed the right strategy. But the key thing we have to remember is we have not given up anything in our core markets and our preferred markets. And the key driver here was for us was the replacement cost of fuel, whether it's coal or petcoke. And we sort of very consciously stayed extremely focused on contribution per ton based on the replacement cost of coal. And that's where the results have to be sort of seen and understood in that background. A little bit more flavor. Q3, well, the month of October actually was a good month to start with. We were quite encouraged. Till November, like I said, it became a surprise both in terms of rains and in terms of construction labor not being back. And what I call, we hit an air pocket in the month of November, which significantly picked up and improved in the month of December. So the mix, if we are low on volumes in the quarter, I think most of that low volumes emerged in the month of November, when the situation was very, very critical on many factors. So just a little bit more color on the quarter. Not every month was bad. October was very good. December has been good, not very good, and November was literally an air pocket from where we have recovered largely. So that's in terms of that strategy now. The way it pans out is, if I sort of share with you, our trade sales are very close to 60% this year, which last year in the same quarter, our trade sales were 52%. So which again, it proves what I just told you, that we actually gave up the markets which were in the B2B segment. And as a result of our sales mix actually shows an improvement of 60% in terms of the trade sales. And I think in terms of the blended cement, again, a similar kind of improvement is with us, where I think total blended, if I look at blended cement, is at 66% this year, vis-a-vis about 63% last year. So that tells you how the strategy was designed and how it was played out. In terms of other details, I would perhaps talk about partly the why our, let's say, trade sales and blended sales are looking better. It's again, one is by ignoring the parts of the B2B market, which obviously reduces the denominator and the percentages look better. But it also has to remember that we have been working on this conscious strategy, not just to improve brand positioning and price gaps, but also in terms of completely overhauling our go-to-market strategies, overhauling our channels, picking up the right channel partners wherever we find that the channel partners do not have the ability to sustain our strategy of improved brand positioning, improved realization. We've been sort of replacing them with better quality dealers and all. So there's a lot of work that has gone on, which is sort of reflected in the mix that we are having. In terms of when we look at the YTD volumes, on the whole, you would see that despite following similar strategy, the YTD volumes are 20% over last year in the first 9 months. I'm sure the industry also is around that level, so we can see that we haven't been sort of lagging behind on YTD basis. And as far as revenues are concerned for our company on YTD basis, we're 28% up over last year. Again, partly it's a function of the market prices being better. But again, to a significant extent, it's also a result of what I just mentioned to you, our strategies to improve price realization, our strategies to sell in the markets which are more profitable, which give us more contribution for what we consume with the cost. Cost escalation has been going on, we are all aware of that. So it's not just the price realization that is higher, it's completely coming from market forces. It's also coming as a successful conversion of our efforts and strategies into the results which the market is beginning to give to us, and hopefully they're sustainable. Obviously, with higher costs, with the higher volumes, which are 20% higher over last year, obviously some of the things in terms of what we call other expenses, which have largely fixed costs, like maintenance costs, for example, do go up when the volumes go up. And plus in Q3, another reason for our other expenses looking higher than last year is also the fact that in this quarter, from the month of October, we also started resuming our advertising campaigns. A new TVC has been released. A lot more support has been provided to even the BTL activities at the dealer counters, and also because of that, in this quarter, if you look at last year's advertising versus this year's advertising, we've just doubled the investment. So that is another factor, but it also leads to a better brand positioning and better realization. So we intend continuing with that strategy. And having given up some of the distant markets, as I mentioned, there is some improvement, although not a very dramatic or large improvement, some improvement also in terms of average distance that our cement has traveled during this quarter. So that's the qualitative comments about it. On the basis of, let's say, numbers that have been printed, you people do know that EBITDA is down 17% over last year and nearly 12% from last quarter. The PBT again at 67 crores is significantly lower from Q2, which was at 85-86 crores. In the previous year also we were about 84 crores. But on YTD basis, when we see YTD basis, obviously our EBITDA is around 290 crores versus 180 crores last year. So improvement of about 110 crores. As a percentage, it's humongous. But percentages are percentages. What we are happy about is we have 110 crores more in hand or in pocket to service our debt and keep moving. The YTD PAT, if you've seen, that's 190 crores, which is nearly 67% higher than last year. Realizations this particular quarter have been at 5,053, which is sequentially also up 5.7%. And nearly 14% higher than last year. As I said, it's a mix of market support and also our internal strategies that we've been trying to implement with great amount of diligence. The another thing that, again, I'm basically going by what the published figures and data is. We're also happy that we followed a strategy on power fuel, which seems to have given us a lot better, I would say, cost efficiency in terms of the cost push that the markets have experienced. Not that our power fuel costs have not gone up, they have gone up, but I don't think they've gone up by as much as they have gone for the rest of the industry. And the key factor there which has played in our favor and that has led to, again, like I said, the improvement in profitability happened because we focus on contribution per ton based on replacement cost. So a large part of that is the fact that if we consider our fuel mix, while coal and petcoke obviously have kept becoming expensive, the AFR, if we purely looked at our kilns, which we use, let's say, these three fuels to produce clinker before we grind that into cement, purely looking at kilns, our AFR percentage this quarter is as high as 18%. Which is something which we feel very, very happy about, and I think it's a good, let's say, overall strategy to adopt for everybody. But we know it's a function of where your plant is located, availability, and also at times the AFR that traditionally we've been using that starts becoming unremunerative if it becomes too expensive in the market. So we are happy to be at 18% of our clinker fuel being alternate fuels, which has given us a huge amount of cushion vis-a-vis the coal and petcoke cost increases that have happened, and we intend continuing with that effort. On the packing cost side, yes, partly it's been because we had to spend money on bags because bag and plastics have remained very expensive in the market. But part of the average and the packing freight cost that we reported going up largely also a function that the volumes have been far lower, and part of the packing cost is typically done on contract basis using contractors and contract labor. We do have some minimum guaranteed commitments, and sometimes when you do not end up dispatching or packing and dispatching as much cement, obviously the fixed cost gets divided by the number of tons you sell. So number of per ton freight packing forwarding as we report is looking higher, partly bags, partly like I said, the fixed cost getting absorbed by lower volume, and and although it's been cushioned a little bit by the fall in diesel costs, but even then for the quarter as a whole, the diesel costs have still been higher. They started coming down and they became stable because of the elections coming up, so that's been a relief. But even then, there has been some fixed costs I've already mentioned, largely to do with advertising and in terms of the higher volumes leading to higher need for maintenance. EBITDA, we calculate, at 980, 990 rupees ton ballpark. It's lower than before, but I think it's a fairly modest fall compared to what we've seen the industry and the markets throwing at us. We have obviously continued to repay our debt. Our debt, and Manish or Sumitra, you can correct me if I'm going wrong, but the debt which as on 31st December was a little over 500 crores. As we speak now, as on 31st January, it's already stands at about 450 crores, which includes, by the way, the deferred sales tax liabilities and all that also is a part of this loan. If we didn't count that, our net debt today will be about 425 crores. So I'm just calling out to Manish and Sumitra, my colleagues, so that if these numbers are little, I mean, little means we are obviously giving you around 5-10 crores in that range, but that's the situation as I have seen it. What else is a matter of interest? Rail dispatches this year we managed to get to 21% against 18% in the same quarter last year. Blended cement, as I did mention to you, is now high 60s. Strongcrete has been our part of our key strategic initiative. I'm glad to say that although we were we took some time crossing the hump of our first target, which was 10% of our trade sales. In this quarter, Strongcrete has actually touched 12% of trade. As it is, trade sales were higher, the proportion is higher. Within that, the Strongcrete sale is 12% higher. So if you look at as overall, that's a mix that's becoming healthier now, with more blended cement and even more Strongcrete. Trade, I already mentioned. In terms of market mix, because we ignored some of the far-off markets, obviously slight movement in West, which I think that we've been reporting on 53% this quarter has gone up to 55. South is slightly lower because obviously Kerala and markets in Tamil Nadu are south, so that we choose not to sell. So percentage hard drop there. And Central also, because Madhya Pradesh didn't give us enough joy to sell. So we also deliberately, some parts of the pockets, some market we didn't supply. So Central is down to 9% from what 10 that we've been continuing to do. That's on the quarter and the performance. On the product side, I'm happy to confirm two things. One, the investment that we had made in AMP Solar has become productive. The capacity has been put up, and Jalgaon plant has started receiving regular power supply from our solar investment, which again is part of the reason why we've been able to cushion the power and fuel costs this quarter, because from October onwards we started getting solar power. Second piece of news which all the investors have been wanting to hear, the waste heat recovery plant at Chittapur, the order has been finalized, and we've ordered and we already have the POR which has been issued by MOEF, and now the rest of the work can start. And for Devapur expansion, we are now in the process of compiling all the data, because the Devapur mines happen to be in the forest area. So obviously the clearances required for those mines are a little more complex. So we are currently in the process of collecting all the data about the forests and trees and flora and fauna, and all those studies will have to be done. So we are in the process of doing that data compilation for that, so the studies can be completed. In the meantime, we should be moving the application for environment approval of the Devapur expansion plans within this quarter. And I know I'm talking in February, so hopefully at the end of this quarter we should be able to apply for environmental forest clearance for the mines at Devapur. So that work is do that on your behalf. So another thing which we managed to do, see, our debt, as we've been reporting, whatever we reported at the end of last quarter, the previous quarter, I mean at the end of Q2, during the quarter, we realized that the debt which was contracted to be repaid by, as we mentioned earlier, even by year 2030, to actually 2031. Because of the long-term debt, it was locked into a much higher rate of interest. And we were, in any case, prepaying the debt. Last time I had confirmed to everyone that we had prepaid every liability that was due up to FY25. And we realized that if you're paying it faster, why are we paying at a higher rate of interest which is applicable to a long-term debt? So obviously we created an opportunity, and that long-term debt which was there has been completely repaid, and part of that for refinancing, we borrowed money from another bank at a significantly lower, well below 6% now is the cost of the remaining borrowing that we have in the range of about 400 crores. So while I have reported the debt to be there, but it's at a much lower cost now. And the old loans which were there from consortium of banks, every penny has been repaid excepting one banker who's lent the money to us, and that repayment is scheduled over the, I think, next about 10 quarters or so, which I think, again, we have the option to prepay if we have the cash flows and if we are not able to deploy that money in, let's say, in the expansion plans. So thanks, Sumitra, for reminding. So debt has been completely refinanced at a much lower cost. And the net, I think, benefit that we have in terms of percentage points is around 1.6% reduction over what the previous borrowing cost was. So that's a very large saving again on the interest cost. It will not appear in EBITDA, but it will definitely appear in our PBT improvements. Yep. And on that point, Samita, since you reminded me, I know that question is going to come up. So while I have mentioned to you that, the Tiroda TOR has been issued, and also in terms of Devapur, we should be able to move environment application soon. So we tried to sort of schedule, not going too far away, but out of the total investment of a little over 2,000 crores that we think these two projects are going to take. Our current estimate is that in the FY23, our total disbursement on those two expansion plans could be in the region of 750 crores or thereabouts. So that, and looking at the cash flows projected and debt repayment obligation, even if we were to sort of start borrowing money, at least FY23 end, we should be at a debt of just about 500 crores, including when we have started doing the fresh projects. And as we complete those things in FY24, rest of the things will come in. But in the meantime, like I said, it's a question of improving cash flows and watching how everything is going. So that's the other bit on, because I know that questions would come later. So these are the answers I'm providing upfront. Hopefully that satisfies that curiosity also. Thank you.
Thank you. So do we begin with the question and answer session?
Yes, please.
Thank you. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Mr. Roshan Pawnikar from JM Financial. Please go ahead.
Yeah, hi. Very good morning to the management. Sir, firstly on your strategy, so you talked extensively on the conscious change in the strategy to focus more on trade sales and more remunerative sales, and the results show the benefits of the same. The question is there enough depth in our core markets to support our strategy, or would we have to go out of our core markets to implement that? And do you have a target sales mix in your mind, and what are the timelines for the same?
Look, if you talk about depth in the core markets, and one of the largest core markets that we are in is actually Maharashtra, and Maharashtra is the largest cement consuming market in the country. So in terms of depth, I don't think there's a worry, because even Karnataka, where we are a rather recent entrant, there's a lot of depth in market like Telangana, perhaps not as much as Maharashtra and Karnataka, but there is enough depth there. And in terms of the targets, typically speaking, look, again, we get limited by what the market for example, the trend is. Maharashtra, when we talk about as a market, I guess we are aware that while Maharashtra, we talk about one market, but if you go to a market like Bombay, it's largely a non-trade market. If you come to Pune, it's largely an OPC market, right? So some markets have a particular characteristic which is actually having to be catered to by almost every player, no matter big or small, how big or small you are. So the limitations from that perspective, but given those constraints, we obviously would be targeting for our sales mix in the next 2 years to move, like I said, we are around 60% now. We would like to certainly take it to about 65-66% within the next 2 years. Looking at the constraints which exist in the market. So it's not that we are saying suddenly we'll be at 80% of trade sales or 80% of the blended market. And in terms of, so that's on trade side. On the blended cement, again, it's now a function of how much we are able to keep ramping up our strong creek, which, around last year we were selling at 7% of our B2C sale. Now we are at 12% already. So the significant traction is being seen. And we would certainly like to now take the next target for strong creek at about 15% of our trade sales, which we would like to achieve in the next, again, 2 years. So that's a brief answer to your question. Thank you. Thank you, Roshan.
Yeah, that's helpful. Just a second question on the cost front, sir. We've seen an incremental impact coming into this quarter. So based on the consumption patterns of the current cost mix and what we have procured, the cost at which we have procured the fuels, the incremental fuel, do you expect the cost to have topped out, or do you expect there will be some more incremental impact coming into the fourth quarter as well?
Roshan, the fact of the matter is these are things on which we go by the markets. When we spoke earlier, all of us somehow were quite convinced with an expectation that from November, mid-November onwards, the fuel prices actually should start falling. That was the assumption because the European peak demand for winter coal, winter fuel requirement will be met, and then suddenly there were dislocation of mines in Indonesia. There was something else happening, supply chain, the ships availability became a problem. So this fuel situation has been a little too dynamic. It seems to have peaked out as of now, but let's not forget, there are other challenges emerging on the energy basket. If, let's say, there is any escalation on the Ukraine matter between Russia and US, we don't know where it might end up. So the expectation is peaked out and the things should start easing soon. But politically, some of the developments are at least keeping me a little bit anxious, saying let's wait and watch. Hopefully it will not flare up because the world can't afford any escalation there. But those are clouds that like I said, we have to just watch and see because none of us has any control on that. But barring something like that, it does seem as if energy costs should now start easing out.
Understood. Yeah, that's it from my side.
Yeah, thank you.
Thank you. Participants who wish to ask a question, you may press star and 1 on your touchtone telephone. Participants who wish to ask a question may press star and 1 on your touchtone telephone. We have the next question from the line of Rajesh Ravi from HDFC. Please go ahead.
Hi, sir. Good morning to the team. Sir, my question, there are 2 questions from my end. First is on the alternative fuel. You mentioned it is around 18% in this quarter. Is that correct?
Yes, for my cement, for my clinker production.
Yeah, for your material production, your kiln fuel. So does it include lignite also, or is it all the, like waste materials, industrial waste and all which you are consuming?
Yeah, no lignite at all for in our.
Oh, great. So this is relatively one of the highest among all the industry participants. Is that understanding right?
Well, I don't have access to their numbers. As analysts, you have much better access. But I think 18% is pretty good.
Correct. And sir, coming to Maharashtra situation now, given that 3 companies have commissioned capacities in this quarter itself, latest one, Sri Cement 3 million ton grinding unit getting operational, and earlier in January we had Dalmia and Birla Corp lighting their plants. So we understand Maharashtra is 33 million ton installed capacity, 10 million ton now getting added on top of that. how will that change the dynamics for players like Orient, which has almost 45 to 50 odd percent or 40 to 50% exposure to Maharashtra markets?
Well, Rajesh, the fact of the matter is competition will keep going up in every market. We know that. And the only thing that we then depend upon is our ability to meet the competition, fight of competition. But yes, there would be stress in the market with people who have put in additional investments, additional capex, beginning to push more volumes to those markets. It will get to dynamics again, which are beyond our control, and we'll have to just rely on our internal resources and our quality of product, branding, penetration in the market, given our long-standing channel partners and all. So we'll have to rely more on that and stay watchful. There's no way we can wish competition away from right? Okay. So we'll have to wait and watch how much volume they'll be able to pick up in how much time and how much goes from various players. We are not the only players. I mean, it might be 50% of my volumes, but by Maharashtra state, our volumes are still very small there, right?
Correct.
And the large players are others, not us. My 50% volume is nothing in Maharashtra market.
Agree.
So we'll have to see how much of stress has to be encountered and finally absorbed by each player. But obviously, we remain concerned, but we don't run away. I mean, when Rajesh, I'll remind you when, again, every time I say, when we're putting up Chittapur plant, similar question, how will you compete? There are so many large players. Then when Shree Cement started coming out, what will you do now? Shree Cement is coming there. So fine, we'll have to kind of watch and do our business. We can't run their business. We have to run our business.
Better. Okay. Great. So we just wanted to, I understand, sir, and this competition is an external factor, and obviously you're inching up on your trade mix, which increases the persistency of sales. So just wanted to get a sense on volume trajectory in terms of amid all this in heightened competition. How do you expect on the existing capacities your volume to ramp up at any view that you would grow at 8%, 10% over next 2 years? Anything like that which you would want us to share?
Again, it's a question of when we say growth. If let's say competition becomes higher in one particular region, one particular market, we try and make sure the number one is we dig in our heels and fight as much as we can. But when it is definitely a question of more supply, then we also diversify our markets. Okay. In the last 3 years, if you notice how much increase we have taken in central volumes, which were never existing for us. How much we have started reaching out even in markets like Baroda, Surat, Baroda, those markets which we were never touching earlier. We're going to those markets. So all of us have sort of a way of spreading ourselves, our arms, and thereby keep making sure that we are selling cement to the extent that we need to. So the overall growth for the company, I don't think we're giving up our ambition just because some new players coming to Maharashtra. And let's also not forget, given the kind of years that we've had last 2 years, and given the kind of budget we've had yesterday, Maharashtra volumes are going to stay constant. They're also going to grow. Okay. So let's not forget that. Because one is the supply side we keep focusing on. Parallelly, we have to focus on what is the demand side growth.
I agree. Demand is critical because in cement you cannot dump volumes irrespective.
Absolutely. And if you ask me, given the thrust by the government, by the finance minister yesterday in the budget, to infrastructure sector, to housing sector, that augurs well. And I'm quite sure the market, as of now, even if you look at next 5 years, my own thought, and that's why we're not slowing down on our growth plans. My own belief is the demand growth will outstrip the supply growth in the next 5 years.
Okay, great.
That's where I'm coming from.
Great, sir. And just as a last question, have you mentioned a blended cement share for third quarter or for the 9 months?
I did say about 67% was the number I gave out.
Okay.
Yeah, it's in high 60s.
In high 60s for the quarter or for the 9 months?
66% for the quarter. 9 months I'll share with you later.
Sure.
For this quarter, 66%.
Great, sir. I'll come back and see you. Thank you. All the best.
Thank you, Rajesh.
Thank you. We have the next question from the line of Raghav Maheshwari from AMSEC. Please go ahead.
Sir, can you just share your mix?
What mix?
Fuel mix.
Fuel mix. Okay. As far as our fuel mix, 18% is AFR, and coal at 63% and petcoke at 19% this quarter.
Okay, but sir, 63% coal is the imported coal or the domestic coal?
It's mix.
Oh. Thank you, sir.
Thank you.
Thank you. Participants who wish to ask a question may press star and 1 on your touchtone telephone. We have the next question from the line of Uttam from Axis Securities Limited. Please go ahead.
Yes, sir. Good morning, sir. Thanks for the opportunity. Sir, our realization in this quarter has been very good. So do you think that this realization can sustain going forward? And if any price hike that you have taken in the month of January, if you can outline that?
Is the current realization, current means what we reported for last quarter, I guess you mean that. Because there's a big difference between the realization that we have in Q3 and what was there in the month of December. December, the realization was a lot lower in the market because the prices had gone down. So obviously Q3 realization numbers that you are seeing for anyone in the industry, anywhere in any part of the country, is not valid for the month of January. As far as we are concerned, in January we have had just about slightly higher than the exit price of December, but definitely lower than the Q3 pricing.
Okay. And sir, earlier we had guided for a volume guidance of 20%. So how do you see the volume guidance going forward for this year?
Well, now obviously what has happened in Q3 has taken all of us by surprise. None of us sort of expected volumes to be so low. So end of the Q3 YTD basis, we are just about 38 lakh tons. So obviously I'm not sort of in a way irrational in trying to sort of assume or to tell you that we'll be able to do 22 lakhs tons in the month in this particular quarter. Not happening. It's very obvious. So we will still try to do and match the volumes that happened for us in this quarter last year. Market supporting, and it's a big question of how the markets go. With last year also, the markets actually suddenly from about mid-February to end March, the markets just were on I don't know what steroid, what booster dose or what rockets they were on. So if that happens, we obviously would want to do even more. But unless there is a big shock in the market, we would like to at least do the nearly 18 lakhs tons or thereabouts of sales in this particular quarter, which should just leave us at about 56, 57 lakh tons for the year. We are not likely to touch 60 lakhs that we were targeting.
Okay, sir. And the last question, sir, what kind of capex we are going to do in FY22?
I think about 700 to 750 crores is what we expect next year.
And sir, in FY22, sir?
FY23 would be perhaps another 1400 crores roughly.
No, sir, this year only, FY22.
Oh, this year, well, the total might be just about, under 60 crores, somewhere between 50 and 60 crores.
Okay.
Between 60 and 70 crores, yeah.
Sorry?
Okay, sir.
Between 60 and 65 crores, I would say.
Yeah. All right. So the CFO is clarifying for you, between 60 and 65 crores. Yeah.
Okay, sir. That's all from my side, and all the best to you, sir.
Thank you, Tom.
Thank you. We have the next question from the line of Dhiral from Phillip Capital. Please go ahead.
Yeah, good afternoon, sir. Thanks for the opportunity. So now when you have decided to front load your capex in FY23, so by when we can expect Tiroda plant to get commenced?
It will happen. I had said within FY24 it should get done. So hopefully we'll obviously try to make sure that it's operative by the fourth quarter of FY24. But like I said, this TOR has been issued, environmental approvals, because some things are beyond our control. But largely we have earlier also we said by within FY24 we should be able to commission that.
But it should be in maybe H1 FY24, or do you expect it to get commissioned maybe in a late FY24?
As I said, our target is that it should be operational at least for 1 quarter in FY24. That's what our target would be.
Okay. And sir, you also, mentioned earlier that our Jalgaon plant is running at a lower capacity, and now there's rising competition. So how you are going to, optimize the overall Jalgaon plant?
As I said earlier, we'll have to see how the markets develop. There is no... See, these things are too dynamic, and almost every day, every week, every month, we find a way to keep surviving in the marketplace. If you have a magic formula, please tell me. I can't pack my plant and take it anywhere else. I'm going to be there, and we'll find a way to fight the market competition. But I can't tell you anything more than that because we don't know how the whole thing pans out with. And again, like I said, we are not the only player in Maharashtra. There would be stress, and we'll have to find ways and means of staying competitive and keeping my facility utilized there. Right? I have no option. What will I do? I can't tell you right now. We'll see how much pressure comes, what kind of strategies, what kind of tactics the competition deploys in the market, and we'll try and do our best to sort of stay competitive. That's all that I can do.
Okay, got your point, sir. So on the debt part particularly, so any debt reduction by FY22 end? As of now, our debt is something like 450 crore, and you said that by FY23, even after this 750 crore capex, we will get 500 crore. By FY22 and any debt, that we are further going to reduce it?
As I said, the debt which is repayable now total is about, not counting the sales tax deferment, it's about 420 odd crores, 425 perhaps. I mean, we would, like I said, if the market stays around the let's say levels of volumes and pricing as we expect it to, we should be able to reduce this debt, let's say from the current 425 to maybe about 350 by the end of the financial year, in the 2 months. That's what we'll try.
Okay. And so lastly on the lead distance part, what was our lead distance this quarter, Q3?
I have said it's somewhere a little over 300 kilometers. We've not been giving very specific numbers for every quarter, but it stays within a little over 10. At times it becomes 10, 15, 20 kilometers more. At times it's 10, 15, 20 kilometers less. But it's definitely a little over 300 this quarter also.
Okay. Thank you so much.
But it's a significantly lower number compared to this quarter last year.
Okay. Got your point, sir.
Thank you. We have the next question from the line of Indrajit from CLSA. Please go ahead.
Hi, sir. Thank you for the opportunity. A few questions. First, when you mentioned that you would strive to do volumes in fourth quarter equal to the same quarter last year, we have seen for the industry as well, utilization was very strong, particularly in the months of February and more so in March last year. So would you think that the industry as a whole would be more like flattish plus minus 1%, or do you think that the industry, for the country as a whole, could grow over what we did last year, same quarter?
Honestly, this is something which not now. I had perhaps said that in the call that we did on the last full financial year results, and I said the kind of quarter we've had. I'm talking about now Q4 of FY21. I'd said that it's unlikely that we'll get a repeat of that. That was the anxiety. So to my mind, it should be flattish to maybe very small growth because that quarter was just too large. I personally, I'm open to that if it grows and if you're able to get more volumes, we have the capacity, we'll meet it. Not a problem. But I would be surprised if that happens, but I'll be happy if it happens.
That is helpful. Second, on your point of pricing currently being higher than last quarter, would you...
Sorry, when did I say that? Don't misquote me. I said from Q3 pricing is lower this quarter so far.
Oh, Q4 prices are lower so far.
Yeah. Yes.
But versus exit, it should be higher. Is that understanding correct?
From December exit, it's marginally higher, but from Q3 perspective, it is lower.
For the quarter. And would you say that the trade prices have done better? I mean, this calendar year YTD, the last 1 month or so versus what we have for non-trade? I mean, has the pricing competition been more for the institutional segment? Would you say that?
Yeah, absolutely. Absolutely spot on. And that's the reason why we used to not sell to some of the customers there, because the gap between trade and non-trade had become too large. And with the non-trade B2B prices being so low, we didn't think that we should be burning our coal and buy cement to them that cheap. So yeah, you're right. The trade prices have done a lot better compared to non-trade. See, we have to understand the dynamics in the market. For many brands, to improve trade sales, improving trade sales is not an instant fix. You need to manage too many things, including creation of brand positioning, including your supply chains, including your channel networks, your service. A lot of things need to happen before your trade sales improve. Non-trade sales very easy. You go and quote a 5 rupee, 10 rupee discount to somebody else, you can immediately pick up the order. So non-trade is easy to pick up, easy to give up. Trade is more difficult, and that's where most of the situations in the markets you would actually find, because trade sales is more difficult to achieve and also increase from that perspective, the resilience of the companies is, and that's why all of you want us to sell more and more to trade. That's exactly the reason, and that's where our efforts are right now.
Sure, that is helpful. And would you be able to give any sense on how was your power booking cost versus purchase price, particularly for fuel in the last quarter? In the sense, how much higher has your purchase price would have been versus what you booked in P&L in 3Q?
Well, as of now, I think we are just about flattish now. Our procurement cost and the book cost in Q3 are very close to each other. No major difference.
Sure. Thank you so much.
Because we still believe the prices are too high, so we are not booking long term. We are just sort of managing our requirements as we go. If we were to book, let's say, a shipload of petcoke coming from anywhere outside of India, I'm still reluctant to do that because I think the prices are still too high. And I'm sort of making do with somehow managing my fuel requirements based on multiple sources, and that's why it's so dynamic. But if I was booking it, if I were to book petcoke import today, a shipload, you know how much it's costing more. But I'm not going there at all. I'm managing my fuel needs through, a multi-pronged strategy and just managing my costs better.
But pricing aside, availability has not been a concern, right? And in the sense of supply chain or booking the orders, that has not been a concern, right?
It's because supply chain has been also part of the constant. That's why the prices are also so high. The prices at the moment availability becomes better, the prices will start coming down. So it has a linkage.
Sure. All right. That is very clear. Thank you so much.
Thank you. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. We have the next question from the line of Ashish Jain from Macquarie. Please go ahead.
Hi, sir. Good morning. So I just had two questions. Firstly, the outlook on demand, that you shared for Q4, given your comment that coal cost hasn't necessarily come down, so does it factor a similar strategy in Q4 where you're targeting the more profitable markets and all, or now we are looking at a more normalized level of supplies from our end as well?
Well, as of now, like I said, unless you get the fuel cost and fuel availability comfort, we would want to keep pushing more and more of trade sales and maintain prices rather than chasing volumes.
So we remain in that mode even now?
Yeah, correct.
So, sir, we haven't seen any material improvement in demand either versus December, because what I understood is that December anyways demand had rebounded. How is January faring versus December?
Normally we don't give out our let's say our sales or dispatch numbers off a month of the quarter, which we will not declare results for. But I can give you a general sense of the industry. Our feeling is the January demand should be just about flat or slightly better than December, not significantly better.
Okay.
It does look very flattish right now.
So secondly, just one housekeeping question on the Devapur clinker. Is that timeline? So I think the timeline we had shared was fiscal 24. Is that we still stick to that? I know nothing would have changed in a quarter or two, but given we are still at a approval stage and all, given the location of the mine, you think 24 is aggressive target we have, and or it's a more realistic thing given some of the other preparations that we may be doing already?
But it is an aggressive target, as you mentioned. But we are doing everything to make it possible. It is an aggressive target. It's not an easy target. You are absolutely right. But we have no reason to give it up at this stage. We still have range, because the way we are monitoring and watching, I think we should be able to do it.
Right. Great. Okay. And sir, lastly, any update on the Rajasthan mine? Has anything moved in the last 3-6 months since we last spoke on it?
On informal basis, lots of things have moved. The government in Rajasthan has finally come around saying they have to respect the new law. It's a very funny thing that you ask a question. It's very difficult to explain. So now the officials, obviously it's not a government stand, unofficially, informally, these people are saying, look, you've always been wanting to do your case by transferring the mining lease in your name. And we are saying, guys, we have not asked for a transfer, we've asked for a change of name in the mining lease. And they are saying now that the extra charges have been withdrawn, why are you still insisting on change of name, and why don't you accept transfer? We think because it's not a technical matter. It is a court order has actually said whatever was in the name of Orient Paper will be in the name of Orient Cement. It is a change of name. It is not a transfer. So that this thing is going on between us and them, because we're saying, why don't you give us a name change? Why do you insist on a transfer? But I think it's moving ahead, and the fact that they're saying please accept a transfer and we'll sign it today, I'm just trying to say, why don't we actually follow the court order which was passed in 2012?
Right.
Yeah. It is actually a change of name, but it is not transfer.
Right. No, I get it. So, sir, there's zero ambiguity on the it is more about in what form and format it happens.
Correct. No, absolutely. No. I think from informal discussion, we know the Rajasthan government is now prepared to let us have the mines. Let me put it that way.
Right. Got it. Thank you so much, sir. Thanks a lot, and good luck for you.
Thank you so much.
Thank you. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. We have the next question from the line of Rajesh Ravi from HDFC Securities. Please go ahead.
Yeah, hi sir.
Hi,
on the Q4, hi sir. On the Q4 volumes, yours in last year Q4 was around 18.5 lakhs. So, a 90% plus utilization versus around 60% utilization, which we have seen in December. So, is that, this confidence coming in is also reflected in your January performance, that you would be able to deliver 90% performance close to that, which would lead to such volumes?
Rajesh, if you're indirectly asking me what I've done in January, I'm not telling you.
No, that's okay. I'm saying,
okay. So all I've said is, last year also, the volume pickup actually happened in February and March. January was not as big as February. It was not equal divided.
It's not spread equally in the 3 months.
And so we were able to ramp up the utilization and supplies to the market very quickly last year, and I see no reason why we should not be able to do this.
Okay, so this confidence remains that February and March could be much better, and then you would be able to match those volumes.
Correct. So anxiety thing, we were operating at 60, how will we suddenly operate at 90? We did it last year also. It's not new.
Correct. From 70% you went up to 93%.
Correct.
And
so that is doable.
Great. And second is on the capex. You mentioned that Devapur, you're targeting that aggressive capex, which remains unfocused. And also this Maharashtra grinding is also the timeline is what you are pursuing, your earlier timeline, the 2 million ton?
Yes.
Okay. And what I understood, this year your capex would be less than around 50-70 crore, next year 750 crore, and FY24 this would go up to 1,500 crore. Is that understanding right? Okay.
Yeah, absolutely.
And WHR is on track by FY23 end?
FY23 and thereabouts, yeah. Maybe it slips into a month or two into the next.
That's okay. So FY24 you would be able to get full benefit of the plant.
Correct.
Right. That's all from my end. Thank you, sir.
Thank you.
Thank you. We have the next question from the line of Shrey Gandhi from Orient Capital Markets Limited. Please go ahead.
Just one question. This will be the last question. I'll be because and then I have another meeting. It's 12 already, and I need to be leaving for the next one. Yeah. So I'll take this question from Aryan.
Hello.
Hello.
Am I audible, sir?
Yes, you are.
Yeah. Rahul, sir, and sir, I just wanted to understand regarding the margin perspective from the margin perspective that like we are able to normally maintain the margins now as an FY21 it was around 23-24%. So can we expect the margins to remain in the same range around between 25 to 30% of like on FY22 and 23?
Look, in our industry, it's very difficult to, we do sort of report percentage margin, but frankly, percentage is less reliable in our industry. It's more around EBITDA per ton, rupees per ton, right? And that's why we've always maintained that we would keep targeting 1,000 rupees tons per ton of EBITDA. Because if the moment you take percentages, the prices may sort of because prices are the denominator there, the change in price will affect the percentage. But for me, what matters more is how many hundred or how many thousand rupees per ton of EBITDA I'm making. Because that's the real money, right? So we'll keep targeting EBITDA per ton of 1,000 to 1,100 is what I've said, and we can still maintain.
1,000 to 11. Okay. Thank you, sir. That's it.
All right.
Thank you, sir. As there are no further questions, I would now like to hand over the call to the management for the closing comments.
I think in terms of closing comments, all I have to do is thank everybody for their time and attention and for very keen interest, because no matter how much all inclusive I want to make my initial summary, even then there are some key questions that come up that show the interest of all the participants to come to this call. I remain thankful for that and thankful for their interest in our company. Thank you everyone for joining us again this quarter, and see you maybe late April, early May again. Thank you.
Thank you, sir. On behalf of ICICI Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you, everyone. Thank you. Bye-bye. Bye.